What's going on is it's a market that had a legitimate purpose to it at the start. And I'm not saying it's an illegitimate market. It's going to go through its growing pains, and there'll be a cleanup period, and it'll be a legitimate market coming out the other side. But it started after the great financial crisis. Banks had a lot of regulatory new rules, and they couldn't make a lot of risky loans that were traditionally the middle market companies and stressed companies and other companies that were lower quality credits. And then the private credit market was born, and it started off like all of these markets, small, and it was done between asset managers, and it was done directly. Then private equity got into it and created private credit funds and raised money from retail and institutional investors to lend money to sub-quality credits that needed capital. And that was fine until the category is now about $2.5 trillion. The last 50% of growth occurred in 2024 and 25. And now the last credit impulse has been the AI debt being issued to fund these data centers. And in the fourth quarter of 2025, First Brands went bankrupt. There was fraud. And then there were some other issues in the private credit world. And people started to ask questions, what's going on there? And then investors started to withdraw funds and found out, lo and behold, they were gated. Now, sophisticated investors knew that these private credit funds had gates on them because these loans are illiquid. There's no secondary market. There's no publicly traded market. And one of the problems is these private credit funds get to mark their own books. And there's been some spectacular marks going from 100 cents on the dollar, then 3 months later it's zero. BlackRock was known for a couple of those, and the manager of that fund has summarily been dismissed. So people are asking questions. What's in these loan books? What's going on? And effectively, we're getting more redemptions that are accelerating. Q1 saw redemptions, and then gates, and then Q2 saw accelerated redemptions at a lot of the big private credit funds. And so effectively, it's frozen. There are some deals being done, but the flows are going the wrong way. And for the category to continue to work, you need constant flows. And it's a category that created a tremendous amount of fees for the people who created these private credit funds, including the carry and the management fee. These funds have been making 3 to 5% per annum on fees, which is, in the world of finance, is quite healthy. A typical equity mutual fund that's actively managed is like, 80 basis points. So it's been a boon for Wall Street, and it attracted a lot of capital. And the capital started chasing bad deals in the late stage of the credit cycle, and here we are. AI has been a growth sector, a lot of speculation, and then the gating factor initially was access to NVIDIA chips. That's no longer the gating factor. The gating factor is water and power to plug these data centers into, and it's just not there. So a lot of these projects are starting to get paused, and the growth is going to slow naturally there. Secondly, over the weekend, Goldman Sachs issued a warning that the credit markets are starting to maybe take a pause in gobbling up more supply because they're worried about return on investment. So there's been a lot of return on investment questions recently. The Fortune 500 companies that have been doing a bunch of pilots have realized their costs of tokens has been more than the productivity, so they're reassessing how much they're going to spend. We have people switching engines to get lower cost models. We have DeepSeek in China. So there's a increasing wall of worry being built up in the credit markets that maybe we funded a commodity-like industry that has got commodity margins. And that's a problem. Additionally, there's also a problem, within the U.S. Sam Altman threatened a price war. Mark Zuckerberg's threatening a price war. So the price wars are beginning. So China's there looking in the background. There's going to be a tremendous amount of competition between the people that are developing these models right now. So what I'm hearing anecdotally is frontier models, while nice, aren't necessary to do a large part of what people do. So they can take a model that's 3 or 4 or 5 months behind and much cheaper, like a DeepSeek or anybody else's old model. So this is the problem. There's been a miscalculation on the profit side of this. I think there was a lot of hype, like there was in the dot-com bubble, in the railroad bubble in the 1800s. They're building a commodity-like industry, and commodity-like returns are going to leave a lot of people holding the bag. Well, we're talking about trillions of dollars of infrastructure investment. The government is not going to subsidize that. What the government might do, and I suspect is going to happen, is if there is a come to Jesus moment and the credit markets stop funding this and valuations on the AI companies in public markets, which are 45% of the market cap of the S&P 500, they'll all reprice. We'll have a stock market problem. And I think if the government does get involved, it'll buy these assets for pennies on the dollar. They're not going to spend trillions. They're not going to bail out the private investors. And if they did that, there'd be a revolution in the country, because that would be, several $1 trillion that we don't have. in. This is not like the great financial crisis where the banking system was bailed out, because without a banking system, you don't have an economy. Without AI, you still have an economy. But it'll be recapitalized for pennies on the dollar, and that's when the true wealth creation begins, much like the dot-com bubble, where a lot of the big companies that we see in the public markets today IPO'd after the dot-com bubble. The dollar, I think, is put in a very important cycle low. I follow my friend Tim Wood's work at cyclesman.com. He's discovered cycles in different asset classes, and we think we saw a 4-year cycle low in the dollar, and there's a dollar liquidity problem going on. As the global economy slows, there's a scramble for dollars. As credit creation starts to go the wrong way, dollars get bid up. So that's what I think is going on, especially the war on the oil. The mini oil shock did not help this situation. On the treasury market, we're looking for one more dip in price in bonds and high in yields, and then we think we're going to see that put in a low, and then we'll get 3-year cycle low in bonds. And as the growth scare and deflation scare start to rear their ugly head, the Fed is going to flip from talking about rate hikes to rate cuts. And that's coming, we think, in the next 6 months. We think that there's this disconnect in the capital markets where people are looking in the rearview mirror about inflation. All our inflation indicators are showing that core is going to be 1.77% in the first quarter of 2027. Now, people don't realize this, but inflation, the oil shock really, spiked inflation. It was easy for us to calculate and pretty much nail what the inflation did over the last couple of months. But 40+% of CPI is housing and rents, and those are continuing to go down. And that's going to continue to bring core inflation down. And there's still a housing problem. Home prices are still too high. There's no activity. New home inventory is at 9 months, which is great financial crisis levels. Existing home sales are dead in the water, and we're seeing prices starting to tick down. So that part of our thesis we put out last year and this year is still rolling along. We got an AI bubble potentially peaking. So we think we're going to be going from inflation worries to growth scare and a deflation scare in the next 6 months. And the dollar's indicating that's coming. The bond market has, I think, one more push higher in yields, and then I think that's it. And then we're going to see the Fed and everybody flip as we roll through time. Now, I'm a market guy. The other unknown is, of course, the price of oil, which after the MOU came out collapsed as we expected. We had 2 scenarios. A dire scenario, there was no resolution until August. We did get a resolution, but now it seems to be that the MOU is potentially off the table at the moment. We'll see. I mean, Trump could come out tomorrow and reverse all this. But if oil got above 100 in the next couple of weeks, then I'd be very alarmed that something else is at work here. Just like what happened in the great financial crisis, we had an oil spike and everything collapsed. It would just absolutely sink the consumer, which is already in trouble. I don't know if you saw this, but May credit card debt dipped for the first time in a long time. We think that was due to the oil price spike. So, oil is a tax on the consumer, and they stopped purchasing everything else. And it would only bring our thesis in a lot faster if there was a huge spike. We look at supply and demand, and their new tenant rents have been plummeting since Trump got into office. A Federal Reserve paper came out and they said that the immigration problem raised home prices 30%, they think. And what the Fed left out of their report is the Fed also contributed to the rise in home prices after COVID. They bought like $1.4 trillion of mortgage-backed securities from banks during the COVID crisis. They put cash under the bank's balance sheets. So then they relent and created new mortgage debt that accelerated the, easy credit made home prices rip up. So there are 2 things. The Fed caused home prices to rise and illegal immigrants did. The economy is taking the affordability for new purchases off the table. Most people can't afford home prices as they are. It's cheaper to rent than it is to own, and I think in all 50 states, if I'm correct. And the only way this gets fixed is by price. And it's happening slowly. The southern states are showing price declines closer to the border. Blue cities are still holding up, but nationally we're starting to see things come down. There's a huge disconnect between homes for sale versus homes sold, and existing home sales are, at 2008 lows. So there's no activity in the real estate market. It's dead.